Good morning. Welcome to our latest webinar and my last one of 2022. Today, we're talking about an always popular sector, buy-to-let. And more specifically, we're looking ahead to what we can expect from the marketplace in 2023. Well, as much as we can in what seems an ever-changing environment anyway. Well, today I'm joined by two true buy-to-let experts who are here to give us their views, but also to take your questions. I'm delighted to welcome Nathan Goodridge, National Sales Manager from Foundation Home Loans, and Emily Hollands, Head of Specialist Finance at One Savings Bank. Welcome both.
Hi, Chris.
Morning.
Good morning. And it's a time of year when illness is rife, so special thanks to Nathan for stepping in at very short notice today.
No worries at all, and apologies in advance of the background drilling and knocking. I'll try and go on mute as best I can to point it out.
It's one of the things from working from home, isn't it? There's all the benefits, but there's also the drawbacks at the same time.
Yeah.
Yeah. Now, these sessions work best if we're covering the topics that you, the attendees, want to hear about. So at the bottom of your screen, there is a Q&A button. Please use that to fire any questions that come to mind, any cases that you might have in front of you, or even anything that sparks off from the conversation that we're going to be having this morning. And we'll do our best to cover them all off for you in what is already a packed session this morning. So let's dive straight in. So by way of an introduction, can you let the viewers know, just in a couple of minutes, just about yourself and your background, what your USPs are and where you feel you're set aside from other lenders in the space? Emily, do you want to start us off?
Yeah, no worries. Thank you very much. Morning, everybody. My name is Emily Hollands, Head of Specialist Finance at OSB Group. I have been with the group now for over 6 years. Kind of started off with national accounts, covering the Kent brand. Moved into Intermediary and precise bridging a couple of years ago. We've obviously been through a merger, so that has kind of created a bit of a super tanker in terms of specialist lender, which I think works really, really well from a buy-to-let perspective, because we sort of cover all bases in our precise brand. You know, kind of easy lending, good rates, moving on to Kent, which becomes more flexible, kind of covering all sorts of different types of landlords, and then onto Interbay, which is kind of next level specialist. So I think OSB Group is a really good home, to be honest, for whatever kind of inquiry, whatever kind of case you've got. We can usually find a brand that will suit the customer. And I taught Nathan everything he knows as well.
That was going to be mine, but that was going to be my intro, yeah.
Over to you, Nathan.
Yeah, so my name is Nathan Goodridge. I'm one of the National Sales Managers at Foundation Home Loans. So I kind of work within a hybrid role. So I look after the kind of South sales team. So if you drew a line kind of West Wales over to Essex and down, look after all the regional account managers within that region, and then look after some of the networks, clubs and packages as well. And as Emily said, my background was OSB Group, so I've been at Foundation for about 10 months, and prior to that, I was actually in Emily's team for about 2 years. So within specialist lending since about 2019. Before that, kind of background then in kind of mainstream, so really kind of seeing that contrast, I guess, between the specialist and mainstream, and kind of I think as a brand, the Foundation kind of well positioned to kind of look ahead in what is going to be maybe a challenge in 2023, and how the kind of specialist solutions within our kind of segments can really help more customers buy property and refinance it as well. Foundation, for those who don't know, largest non-bank buy-to-let lender in the UK. So really help customers from your first-time landlords buying their maybe 1 or 2 properties, right up to your portfolio landlords with 25 mil kind of facility to maybe do a large incorporation and everything in between. So quite heavily into residential, as well as specialist properties, so your HMOs, multi-unit blocks and short-term lets as well.
Excellent, thank you. Nice introduction there. So if you've got any questions for any of the lenders, any of the brands that you've heard mentioned there, please fire them in and we'll get looking at them. So sticking with you then, Nathan, 2022 has been another year of challenges and problems, just when we think we're at the back of a pandemic and everything else, especially over the last few months. Now, we've all seen it from the broker side. Can you give us a quick overview from the lender side, how the last few months have panned out for you?
Yeah, definitely. So we've had a really good year, and despite all the kind of challenging headwinds that we've had, especially when we take the Liz Truss month, war in Ukraine, cost of living, and so on, we've had a really good year. There has been challenges, and I think pricing and solicitor kind of timescales has definitely been a big one of that as well. What we've been really focusing on this year is kind of building reputation and brand. will lend the same this year as we did last year. But just to kind of paint the picture, in 2020, we lent 50% of what we're on track for this year. So we've kind of done a leapfrog over a lot of some of our competitors, and we're just trying to build to scale that kind of business model as well. So for us this year, our main kind of key priorities, which you'd have seen from us, is that we've really been hard, I guess, on pricing early. So rather than get cut short where we've maybe had a really attractive rate throughout the summer, and then when it comes to then securitizing it, be sort of hamstrung with it, we've really kind of been quite broker friendly. We've given 3 days notice anytime we've pulled a rate, 3 days notice to get a dip in, and then 3 days notice then to get the application in. So we've been happy to kind of take that hit on the business side by giving brokers a bit more kind of flexibility to get that in. So yeah, it's been challenging, but also been successful. I think specialist lending as a whole, we naturally pick up more customers the more volatility there is in the market, unfortunately, and I think that isn't going to ease down anytime soon.
Thank you. Emily, how's it been from the OSB side?
I think no lender can sit and having gone through everything that we've gone through this year and not have had it quite challenging. And I think that goes for everybody, not just in the mortgage market. You know, with, like Nathan said, you know, the trustonomics, the war, COVID, Brexit, you know, what we're essentially in at the moment is a false economy, and that makes it very, very difficult to plan forward, to price accordingly, to kind of really understand the full impacts of those changes, because ultimately it's unprecedented. So there isn't really a playbook for how to do these things. So, you know, the market has really struggled, and I think all lenders have been in a challenging position. From our perspective, in terms of pulling rates and stuff like that, it's really challenging for lenders to work out how much money or work out the margin on products when we're in such a volatile market, when swaps are going up at a rate of knots and you just don't know what the next few months look like. So it is really difficult for all lenders, whether you're a bank lender or a non-bank lender. You know, swaps are still relevant to your business. Thankfully, we've been in a fortunate position where we haven't had to pull any pipeline. We've honoured everything that we've had. Even though, you know, that's created service pressures, naturally we've had to pull rates, and we've given people as much notice as we can. But I think, you know, no lender wants to be in the position where they pull a rate with, you know, 5 hours notice or 2 hours notice. You know, that isn't how anybody wants to operate. It does us, you know, nobody any favours from a lender perspective, because it ruins our relationship with you as distributors and brokers. But as I said, it's unprecedented times, and there's been decisions made across the market which have probably, you know, not been the best customer outcome from some lenders, but equally you're kind of faced with no choice. OSB obviously being a bank lender, so funding's really secure. It hasn't impacted us, as I said, in terms of having to pull pipeline, anything like that. And whilst we did sort of have a break for a couple of days without rates in the midst of the trustonomics, it was a really temporary measure, and we had products back out there less than a week later. I think looking forward, you know, margin is still a bit of a challenge, but we've obviously seen swaps come down. But we're at a point now where it's December, it's Christmas, everybody's kind of waiting to see what happens, and no lender wants to be on the front foot, because they'll be inundated, and then that will cause service pressures. So I think, you know, it's quiet at the moment, I think people should enjoy it, because come January, I think it will go crazy again. Yeah,
I think December's a nice time to catch up as well, isn't it? So where there are those service lags.
And we don't usually get that. It's usually manic right up until, you know, literally Christmas Eve. So I think it's important for everybody to kind of take a little break and take stock of the year, because it's been a mad one, hasn't it?
Just a bit, yeah. So you mentioned a couple of challenges there. Is the one in particular that you think has been the biggest challenge?
I think probably across the market, service has been the biggest challenge, and that's really kind of a knock-on effect of COVID, I think. And again, we're seeing that across all industries, not just the mortgage market. You know, we're seeing it across hospitality, construction, manufacturing. You know, lots of challenges. You can't get the people. You know, inflation. So it's just causing many issues. So from our perspective, services has been the biggest challenge, because we rely on people. So we've had a massive recruitment drive this year to get more people into our business, and it's great because OSB Group is obviously a big company. There's lots of benefits, lots of perks for coming to work for us. So we've been quite successful in getting our staffing levels up. And I think it was yesterday our chief exec announced that we've got over 2,000 staff now, which is fantastic. It's great to see our company growing.
Yeah, I think service has been a real challenge across the board this year, based on not only what can be delivered, but also I think what people expect. COVID changed a lot of that. Everything was almost instant, wasn't it? You know, the move to online shopping and Amazon and everything else kicking in at that period, it kind of just changed perceptions a little bit on what was possible. Yeah, I
think the brokers have had a really challenging job to kind of educate customers, because it is a very different environment to what customers have expected. And that certainly everybody, you know, all the firms that I speak to on a day-to-day basis have been kind of really understanding, and all people want is just their expectations to be managed accordingly. You know, you just want to know how long it's going to take. Doesn't necessarily matter what that time frame is, just manage an expectation. So again, I think as a lender, if you are under service pressures, that's the best thing you can do. Just kind of own it and be honest about things.
Yeah, definitely. Thank you. Nathan, how about from your side? What do you think the biggest challenge has been for this year?
Yeah, I'd say it's kind of twofold. I think to echo what Emily said just about the service side, I think speaking to a lot of brokers are a lot busier this year, writing the same amount of business as they would in a normal year by rebrokering the cases elsewhere. Maybe lenders are pulling rates at offers, and there's some, you know, lenders are obviously clamping down. I draw everything back to kind of war in Ukraine, because I think that has the knock-on effect on everything that we're seeing at the moment. I think the subsequent effect on the global markets, and in particular for us, obviously being a non-bank, that then coming down as the pricing pressure. So for us, we've been kind of pricing higher in a position to come down. So we've been able to manage a one-day SLA pretty much all year this year by being able to kind of price, like I said, price higher and then come down when the time is right. But the ICRs are obviously, I think we'll probably get on a few questions on it as well as we go on, but I think that subsequent knock on the ICRs is something that we haven't seen since, you know, the Section 24 was introduced back in 2017, and now we're really starting to feel that bite of what happens with the PRA changes when you've got a higher rate in there as well. And we are seeing a lot of, you know, I had a broker yesterday go through the rental calculator, and the max loan was about 38%. So that is really hamstringing a lot of landlords being able to release, well, even release cash, but even just leave a lender. So that is what I'm definitely seeing over the last, say, 3 or 4 months is probably the biggest challenge.
Okay, that's interesting. Which leads us nicely on to the next point. We're seeing now rates starting to come down. We're seeing stress rates, ICR, starting to fall as well. How do you think the next few months will pan out from that point of view?
I think, like Emily said, we are in a bit of a false economy, and I think it is positive to see swap rates and obviously wider rates coming down. But I think looking into 2023, we know they're going to go back up again at some point. So it does come with its own challenges for lenders to price accordingly, and looking at, you know, the standard app to completion time and really be able to judge that so you're not cutting yourself short. I think we'll see a lot more discounted options. Already seen it now where lenders come out with, like ourselves, we've got variable products without ERCs. So it's giving landlords the option to not fix into potentially what they deem as a higher rate and kind of ride out the storm. And I think maybe a lot of high product fees and lower rate, again, to kind of alleviate some of the pressures on the ICR stuff. And hearing a lot of lenders looking at long-term fixes as well. So long-term fixes with flexible options, again, just to kind of stimulate some sort of wiggle room, I guess, within the ICR space.
Okay, so product innovation, I suppose, then, would be something that will grow off the back of this.
Hopefully, yeah.
Yeah, thank you. Emily?
Yeah, absolutely. I mean, you know, we've been talking about product innovation for years, or as collectively as lenders. So, you know, we always say we really need to now. And I think we've seen some great examples of that already. You know, low rates, high fees, which on the face of it, you think, oh, that's madness. But actually from a buy-to-let ICR calculation, that's exactly what you need. And I definitely think we'll see more of that going forward. And perhaps a return to trackers, you know, that they were prolific, 5 5-10 years ago, and actually completely moved away from that, and fixed became the key. And I think now we might see a return towards that, which is great. It just creates innovation in the markets. I think, as Nathan said, there is still pressure on rates. We still don't know what's going to happen from a long-term perspective. We work at OSB Group with a really fantastic economist who has his own company called Lazarus, and they're pretty good at providing us with kind of an outlook on where they think the market is going to hit, kind of what's going to be the sort of pressure points, etc. And I think the interesting point is swaps aren't really following the Bank of England at the minute, because we've actually seen them drop as base rates risen. So that's interesting. So swaps are still volatile, but I think it could go either way. What we need is a period of calm and period of settling times where we just sort of carry on and sort of steady the ship and get back to some form of normality. I'm going to quote that because it's normal these days. But yeah, I think it's a really interesting time to see what lenders come up with. And I'm fairly certain from conversations that I've been party to with internally, then we will have products that kind of suit the market out there in January.
Okay, it's good to hear. So with all of that said, we've touched on like the negatives there. How has 2020 been overall for you? Stick with you, Emily.
2020.
So 2022. How's it been for you? I'm not going back that far. We've already gone through a negative period enough.
Yeah, I mean, we've from a lending perspective, we've sort of achieved everything that we wanted to achieve. As I said, there has been service pressures, but we've worked through them. I think we've been honest and open about them. We've kept in contact with our key distributors, sort of listening to feedback and improving where we can. I'm always kind of get to December and you just think, right, will we go again now? Which is a phrase my boss always used. So it's easy to kind of write the year off and start looking towards 2023. But yeah, overall good year, absolutely good year, despite everything else that has been going on.
Excellent, thank you. Nathan?
Yeah, definitely. Like I said earlier, we've kind of hit where we've kind of targeted for the start of the year, and kind of getting ducks in line for next year. Again, we've talked about service, but that our main objective this year was to obviously hit our same completions target, but also improve our NPS score. And we're now sat at our highest NPS score since we've started kind of looking at it. So we've kind of been able to hit both objectives. I think coming back to the service bit, I think brokers will see this as well, and as well as every other lender, but the business this year has just been in complete waves. Is that people have been pulling products and pulling rates and changing them maybe 100 bips at a time. It hasn't been, the 0.1, the 0.2s. So if you were to look at our kind of applications on like a linear chart, they're just like that. And then that then obviously comes with the operational pulls with it as well. So for us, we're just kind of, for brokers who've sourced us recently, we are sort of bottom of the pack on sourcing at the minute, as we're kind of just looking at next year, kind of where do we position ourselves. We are looking at kind of branching out in regards to proposition. So really developing the residential side. We've launched an F4 range now on residential. So we're looking at where we think customer trends will be over the winter, potentially adverse credit, unsecured arrears and so on, and matching our proposition to that changing customer dynamic as well.
Okay. And leads us nicely into 2023. Obviously, no one knows what's around the corner. No one could have predicted most of the things that have happened during this year, but we're going to spend the next half an hour trying to do that. So what do you think the biggest challenge ahead for landlords, first of all, Nathan, would be for 2023?
I think it's rates and ICRs, and I think that's both us and landlords. And as Emily said earlier, fixed term pricing is a challenge. And we're seeing that even today with some lenders who have reduced products, who are making it maybe a little bit more difficult for those who've maybe fixed in on higher ones 2 months ago. So that when to hedge and when you're securitizing, will continue to be a challenge, and that will naturally just sort of bleed back into landlords as well. I think as well, just kind of looking out to 2023, and I think it is quite easy to be caught up in some doom and gloom looking at the media and news, but the COVID years has given us a bit of a boom with stamp duty, low rates, and a lot of selection out there from a lender's point of view. But I think 2023 will be a correction and landlords will see that. But I think looking overall, I think we'll be more aligned to prior to COVID years rather than it being like a 2009, 2010 kind of time. Lenders are well sort of capitalized, well geared in regards to still wanting to lend. There's a really big appetite out there. And for landlords at the minute, we do BDRC survey, which is sort of quarterly landlords survey, sorry. The last quarter reported the highest demand for rental properties since before 2016. So that fundamental of a buoyant market is still there. It's just for us as lenders to be able to meet that demand with products. And I think that's just what we'll kind of see going into next year, I think.
Okay, thank you. Emily, where do you think the biggest challenge lies for, let's start off with landlords coming into next year?
Yeah, I'd agree with Nathan to a degree. I think rate pressure will impact, how much gearing they can do if they're looking to expand portfolios. I think, landlords have faced challenges for a long time, and we've already seen a massive shift in the buy-to-let market back from the 2016 changes. So actually, the majority of landlords these days are professional landlords. So that they're a kind of different breed, really. They're doing this as a business, so they are more aware of the market and rates, and they've got a long-term plan. And yes, the current market may stall that, but will it have a long-term impact on them? No, I don't think it will. I think the biggest pressure at the moment is probably the EPC changes, which I know that we're going to talk about, but I think that's where landlords really need to understand the impact that is going to have on them at the moment. From a lender perspective, we have been the largest specialist lender in buy-to-let for a long time. We have no plans to change that. We work really closely with our landlords, and actually what we're looking to do is strengthen that relationship. So we have a new team now, a high net worth team, who would look after our professional landlords, and we're sort of planning to be closer to them so we can kind of help understand their business and things like that. And it's quite timely actually, because we've just kicked off a massive new piece of research called Landlord Leaders, where we've gone out to a lot of our existing landlords. We've had lots of in-depth conversation with our key partners, really to understand how landlords are feeling, what they think is the biggest pressures for them in the market at the moment. And I don't know whether you would have seen yesterday, we also confirmed that we've got a £50 million fund that will be kicking off into the new year, and that is essentially to help landlords, particularly with the EPC stuff, but I think just commit to the fact that we are a buy-to-let lender. We've always been a buy-to-let lender, and there's absolutely not going to be any change to that now, despite what we're dealing with in the market.
Yeah, I was having a conversation with a lender a couple of weeks back, and one of the points they brought up, I think, is quite relevant for today, where there's almost now, there's two different types of landlord. There's the hobby landlord, and they might be the ones that are struggling a little bit more because the stress test calculations, dropping rate, maybe a tenant not paying has a real impact on them. And then you've got the professional landlord who, as you say, Emily, run it as a business, who seem a little bit more immune to what's taken place so far. Yeah.
And I mean, it comes back to sort of you guys as intermediaries as well. I think if you're close to your clients as professional landlords, then you're in a really strong position to kind of educate them as to what's happening in the market and what potentially could come down the line, and how that supports their business plan and their growth plans going forward. I think, Nathan mentioned the press. I've got a lot to answer for in terms of scaremongering and things like that. Not all press, but and I have to always say that just in case anybody's from the press, but it's not everybody. But even yesterday, I read something in the Times about the unmortgageables, and it's self-employed and it's this and that, and it's like, that's not true. That isn't true. So again, that's where the importance of having a great firm like Crystal, or to actually speak to clients and actually say, things are not quite as they seem in the press, and actually these are your options, this is what you can do. But yeah, ultimately you're right, there's two different types of landlords, and those smaller landlords were probably always going to sell, always, it's always their long-term plan. As I said 2016 started a shift in the buy-to-let market, and that's still continuing.
Yeah. Thank you. So Nathan, we touched on the EPC proposals. Do you think landlords are aware enough of the EPC changes that may be looming for them?
I think they're aware, but I think aware enough is probably another question. So again, in the survey that we've done with BDRC, 9 out of 10 landlords do say they're at least aware of the changes and where they need to get to as well. But I do definitely think there is more education, and we've already touched upon it about product innovation as well. And I think brokers play a massive part in this as well, because you are the one speaking to the landlords, speaking to the customers. I'm seeing a lot more advisors now build in the EPC question or the discussion as part of the advice as well. So anyone you're doing on a 5-year fix or close enough to a 2-year fix will be coming out in a different EPC landscape as such. So you might be their first sort of touch point to educate about where they're going to be in 2025. So I think the role of the broker is bigger than ever. But from a lender's point of view, I think there is much more that we can be doing. I think there's a massive opportunity to be looking at back book, and I know Emily said with OSB on obviously the 50 million fund to kind of look at that as well. So I think for landlords, it's just keeping it in touch with lenders and keeping up to date with wider market kind of innovations and news, and kind of piece that to that customer and to the advice needed as well. But I do think as well, when we've done a survey last week, and not many people were kind of introducing EPCs as part of the question, but I think a good EPC for landlords goes hand in hand with rental demand as well. If you can tell a tenant amidst the sort of cost of living crisis that you might be able to get the house a little bit warmer for a little bit longer, or make their bills, you know, a little bit more affordable, there might be some tandem to kind of work together in there as well. So I think it's a massive opportunity. I think it's another touch point for brokers, to touch point with all their existing client book, and kind of just gauge how much do they know ahead of when the changes need to be done by.
Yeah, that's an interesting point, because when the first green buy-to-let products were launched, I think a lot of our brokers were almost accessing them accidentally. Yeah. They were applying for a standard buy-to-let, and then the EPC came back, and a bonus, I can have a lower rate, rather than driving the application down that route to begin with.
Yeah, I think it's twofold. I think there's some products which incentivize for having a green property, and I think some products are geared to help you get your property green as well. And again, learning the difference and where to put those customers is that, you know, we've seen customers be placed with us that weren't on a green product, but then when we've asked for the EPC, they are eligible for it, and then we've been able to switch them over. But when you think of how much interest that product difference has actually saved them, it's massive. And for a broker to be able to give that news as well is obviously even greater again.
Yeah, especially with the ICR pressures on top of that as well. Yeah. Emily?
Yeah, I think in green products, it's quite easy to stick out a product that's a little bit lower and call it green, and that's great. As you say, in a cost of living crisis, if it saves on interest, that's really good. For me, the more interesting part is how are you going to help landlords get those properties up to the required EPC rating? And from the research we've just done with landlord leaders, the good news is the majority of brokers are aware of the changes. So that's a really good step in the right direction. I would say, yeah, Nathan's probably right. It's around 30–40% of landlords that know about it, which is very similar to what it was in 2016 when the PRA changes came in. It took a long time to get landlords up to speed. And part of the problem is the information out of the government is really ambiguous. It's not clear, it's quite vague, you just sort of don't know what your requirements are. But again, I think tenants will start to demand greener properties, because that's the way the world is going. We have to, like it or not, the way we live at the moment is not sustainable long term. So we all have to make changes from a green perspective. If you look at the demographic of renters, people that are more likely to rent properties, they are more likely to kind of want to be more green. And again, cost of living crisis. If you can rent a property that's going to cost you less on heating, you're going to do that at the moment if your income is already stretched. So landlords have a responsibility to their tenants to make those properties as green as they can. And again, I've mentioned it, but the landlord leaders fund that we've introduced will go a long way towards that, not only just for our back book, but also for new business. So, we will have products out there in January that will kind of support refurbing those properties. But you can also go back to basics. You know, you can potentially buy a property at auction on a bridge, refurb that, and then you've got a property that has the relevant EPC rating. I think as well as that, you know, the other thing to bear in mind is not all properties can get to a certain EPC standard. So actually what landlords have got to do is just prove that they have done everything they can. And it isn't necessarily about let's get a heat pump outside or whatever it is that people keep talking about. You know, there are much smaller things that can be done that improve your EPC rating of your rented home. So I think it's important to put things in context, and it's not just about suddenly revamping the whole central heating system and doing all sorts to the property. There are small changes that you can make that will make a difference.
Yeah, not to bash the press too much, but that's something that we're not very good at, sorry, is it? Getting that middle ground, finding a way to get things done. It's much more sensationalist, and it's going to cost a fortune to get to that level. Actually, not as many properties as you think that need changes in order to improve the EPC requirement. Again, you know, if you read the press or if you know some of the commentary, it's you know, every single rented property is not at the required EPC. Well, that's just not the case. It's a smaller number of properties, and an even smaller number that can never change. You know, listed buildings, things like that. It's actually a small number, but still relevant given how large the PRS sector is. Yeah. Good point. We're seeing more and more applications now for people wanting to either get second charges or remortgage properties in order to release capital to do the works. So it's a great opportunity if you have got landlord clients with portfolios to have a look at some of the properties in there. The bigger the portfolio, it tends to be the lower geared that portfolio is. There might well be equity in there that you can pull out to get these properties up to standard well ahead of schedule, and then benefit from the lower rates that the lenders are offering as well. Yeah. Something that was raised prior to this, do you think the EPC regulations will come into force, or do you think there'll be a stay on them? Just quick opinion on that, given everything that's happened to the market over the last 12 months. I think the dates might change. I think the ultimate goal won't change. You know, I think, as I said, you know, current way of living is not sustainable, no matter how green you are or are not. You know, you will eventually will have to wake up and realise that we do need to change things. So government have got net zero target 2050 or whatever it is, and I think that it's just potentially the 2025 2026 dates that will potentially change. Nathan?
Yeah, no, I'd agree. I think potentially dates, maybe more intervention from government to help us get there, but I think end goal of why we're doing it in the first place, I think definitely will kind of stay there. Yeah.
What do you think, Chris?
Yeah, I think, yeah, I agree there. I think the date will be pushed down the line. I think it might not come in 2024, 2025, but the A to C rule will be put in place at some point soon. We're also seeing a demand for, it's unusual someone asked me a question on these, that kind of threw me a second then.
Sorry.
That's all right. We see more and more demand for top slicing as well, especially given those ICR pressures. What are your views on that and the access that landlords have to that, Nathan?
Yeah, so I think it's a great tool to be able to get around the ICR issue. I think the constraints that we have as a lender, so spoiler alert, we don't do top slicing with us, just because of how we securitize and the risk policy that we have signed off with funders. It's agreed that all properties, if they were to be repossessed, would be easily lettable and in essence profitable above the kind of PRA guidelines. So if we were relying heavily on earned income from someone that we in essence just repossessed from, that wouldn't sit right with us. I do think we'll start seeing more of it and more lenders kind of dip their toe in the water. But that's not the only way of doing it either. I think that it does help release the sort of valve on the yield. But I'm starting to see a lot more brokers, a lot more lenders now sort of look at maybe like rolled up and deferred interest, with kind of advancing the interest from day one, so it's not actually part of the ICR, which again is probably a really good tool for maybe landlords who are looking for properties for capital growth rather than yields, so still looking at the London market and the Southeast market. So I think there does need to, like you said all along, I think there does need to be more innovation, but I think there probably is a bit more just in top slicing that we could potentially look at to get through it. But when I was at OSB and a previous lender, we did do a lot of it, and I think it is a great product as well.
Thank you. Emily?
Yeah, I would agree with that. You know, it is an option, but it's not going to be the right option for every single buy-to-let mortgage. Historically, you know, we would be looking for high income in order to support the buy-to-let mortgage. And as Nathan, you know, really good point. You know, you don't do it, and I think you've got a really good reason for that. And it's not always the most responsible product. It's not necessarily looking after the customer, which is obviously key as a lender. So yeah, I think there's definitely a place for it with criteria, but actually I think there are other things that you can look at before you maybe get to that point. And that's the great thing, I suppose, with OSB Group, is you've got 3 different brands to look at. So if your kind of buy-to-let deal is very black and white, then you're looking at Precise, and that's nice and easy and go through quickly. If you do need that flexibility or more specialism, then you can consider Kent Reliance and Interbay. And that's where manual underwriting comes in as well. And that's where you kind of look at the whole picture. It's not just a case of, well, this doesn't meet the DSCR, so we're going to reduce the loan. It's what's the situation? You know, let's have a look at it from a holistic perspective and really understand the client and see if there is an opportunity for us to lend more based on other factors. And that's, you know, that's where specialist lenders as a whole are brilliant, because, you know, we do pave the way for that kind of flexibility, innovation, which the high street lenders just are not in a position to be able to do.
That's a very good point. The buy-to-let market over the last few years has gone down almost that sausage factory type route, hasn't it? Where it's how quick can we get the deal in, get it processed and get it out. And the key, especially when markets change, is that manual underwrite. And it's something that, you know, we've been very close to for the last few years. And the specialist sector that we work in, we've actually got busier this year. So we're about 30% up on fundings this year compared to any year in the past. So the harder it gets in the marketplace, almost the better we do, because people need that specialist approach rather than just fire it into a calculator and see what comes back.
I think the more volatile the market is, and if you think just back even to, you know, since the tax changes come in, it does play into brokers and in particular specialist lenders' hands. It's given a more, you know, I can't imagine a landlord walking off the street going into a NatWest or Lloyds Bank and being able to place a buy-to-let mortgage. You know, they need brokers, and I think that creates an opportunity for us. Yeah, it'll be more difficult to place these cases, but it does open more opportunities to look at wider options that they may have as well. Yeah,
and again, the long-term goal for that landlord, are they looking for, you know, monthly rental income to come in, and is that their income? Are they looking for yield? Are they looking for capital growth? By getting close to your landlord, you can really maximize the potential for them and for yourself. Yes, that's a really good point. Where do you think brokers should be focusing into 2023? Emily, we'll start with you with that one.
So for me, the existing client bank is the most important thing, I think, for brokers. New business will tick over, and I think that will still come in. But I think gone are the days where you can just contact your client, a month before the deal's ended, or even 2 months before. I think it needs to be a constant relationship now, from an education perspective, from an understanding perspective. I think that's the biggest thing. Are brokers in touch with their clients on a regular basis so that they can help them with new opportunities, existing opportunities, remortgaging, growing the portfolio, understanding the EPC changes. There's just so much. It's not just about deals coming to an end. Let's have a look at another product. It should just be a constant relationship. The market, all reports I'm seeing is kind of leaning towards a quieter market next year. But I still think, there will be lots of new business opportunities. And again, you put it in context, 2021 was a buoyant market because of, external factors like stamp duty and things like that. And it's not really a true market. So whilst we might see a reset of house prices and activity and things like that, it's actually not, it's probably just more realistic than what we've had in previous years.
Yeah, I think the difference, all the pointers are that we're headed into recession into early part of next year. I think the big difference,
are we in it for months?
Feels like it, yeah. The big difference this time is that there's capital there. Lenders are ready to lend. Lenders are now much more stable and much more well securitized than they were previously. So it's not like the 2008 crisis where there's no money available. It's a very different marketplace.
And that is a really key point as well. And I think one that people miss, this is not the credit crunch that we had in 2007, 2008. This is not banks getting nationalised. Lenders have learned, lenders are better funded, lenders have better policies in place, and despite, whether you're bank or non-bank, as I said, there is still funding out there. I'm in touch with other non-banks who have got their funding sorted. It's just perhaps redoing the business plan a little bit and just thinking about when you hedge and making sure you're securitizing at the right point and things like that. But absolutely, this isn't the credit crunch. And if anything, I reckon we'll see a couple of new lenders coming in next year, because there are still some niche areas that are underserved. And that's when you get new lenders coming to market.
Breeds innovation, which is something we've touched on quite a lot during this.
Competition, which is always needed.
Yeah, thank you. Nathan, where do you think brokers should be focusing?
Yeah, so I'd say two things. I'd definitely echo what Emily said. I think definitely a contact strategy. So if you haven't already invested in a CRM platform, looking at the wider technology that is out there to keep in touch with brokers, with customers, as the year goes on. I think the market is volatile. I think a lot of customers will be looking at their direct debits and quite concerned. So having that contact throughout next year will definitely not open opportunities for yourself, but also obviously put your customer in mind as well. And I think the second one really is kind of just diversifying and education just about the wider market that we operate in. So looking at products that you might not be comfortable selling. So attending these excellent webinars with Crystal is your first sort of point of call, that you've at least kept up to date with what every lender is doing. So, what specialist lender have you not spoken to in the last 6 or 12 months? Find out what they can do and how they can help your business moving forward. Because if you're looking at your own personal income and how you'd future-proof that, it is looking at how you can kind of find, the fundamentals of a good market is still there. People want to buy, people still want to own property, and people are still looking at renting. So how do you fit that with product propositions so that you can help more customers, but also protect your own business as well?
Yeah, good point. I think with the diversification also comes additional products, maybe things that you wouldn't normally consider. So things like bridging finance, for example, second charges on properties. Maybe look at that semi-commercial property in the portfolio and see if you can get that placed, rather than it being just easy to do the standard residential or the standard buy-to-let.
Definitely. Well, I think if you look at like cost of living at the moment, if you're a single person living in a flat in London, struggling with the heating, electric bills, and so on, that demand for shared housing is now bigger than ever. How many brokers are really comfortable with the HMO licensing, planning, and so on, and actually be comfortable to actually set that up? But there's good returns on there. There's good capital growth from there, and it's again for brokers to kind of educate customers, or even refer to packages, master brokers, to kind of be able to place that business. So it is just knowing the wider market for you to be able to give the best advice, I think, and more solutions to your customers.
Yeah, very good point. And even if you don't know the answer, there's plenty of places you can go to find that out. You can pick up the phone to us. You can visit numerous lender websites, and all the information is there to help out. At the end of the day, we don't deal directly with the customer in the first instance. We're dealing with brokers. You're dealing with packages and brokers. So it's up to the broker to spot that opportunity to begin with, and to engage and to have that conversation and to get that spark really moving.
One of the guys in my team has a really good kind of hook, in talking about diversifying. Have you got any self-employed clients? Are they renting premises that they operate out of? And if the answer is yes to those, then you've got a semi-commercial mortgage potentially on your hands there, because they should be buying their premises to operate out of, because it's tax efficient, and it's growing their business essentially. So I always think that's a great hook really for brokers to consider jumping into next level market, bridging, commercial, things like that. But equally, it is a minefield, it is complicated, and if you don't feel comfortable, know that you have got distributors like Crystal out there who are more than capable of placing that for you.
Yeah, that's a good point. And that question is on everybody's fact find. Are you employed or self-employed? And then that opens the next question beyond that. And it's about doing the best for the customer, isn't it? Obviously, we all want to complete as much business as possible, but if we can get the best solution for the customer, that's really the ultimate driver for all of us. We've had a question just come in live. where does the panel think rates will peak next year? That's really putting you on the spot. Emily, do you want to start us off with that one?
It's a lovely face there, isn't it? Well, I think we'll see them go up maybe another percent and a half, something like that. That was always going to happen. That has not changed. Those predictions haven't changed since back end of the summer. We were always going to see a Bank of England base rate in the 4s. And I think that will potentially still be the case. But again, as our sort of Lazarus, the economist firm that we work with, the quicker they peak, the quicker they'll come down. So actually, it doesn't really, obviously it matters because it's going to pressure interest rates. But I think what we need to do is look beyond the next few months and understand that rates will come down. It's difficult, isn't it? And not to labour the point, but most people that are currently buying houses, in that sector, they've never seen a base rate this high before. Whereas us more mature, older, can't see who's on the webinar today, but the older you are, and if you're around at the last credit crunch, then that kind of a base rate is not really a shocker. And if you go further back into the early 90s and the 80s, the base rate was crazy then. I guess we just have to watch the pressure on affordability. That's the big thing, because people do borrow more now than they used to, and that's the bit that we just need to keep an eye on, really.
Nathan?
I'm always really conscious of coming up with numbers, but yeah, so I think I think we're sat at 3% at the minute. I think looking at a lot of sort of predictions for next year, I would say the kind of average about 4.5. That is down 1.5% from when Truss was in power and they were expecting 6%. So I think we're in a lot better position than we were maybe 6 weeks ago. But yeah, I think even though that it is expected that we'll kind of peak next summer, and that's when obviously it will be more difficult. I think what we're in at the moment is kind of the new normal. I don't see and I think the days of 2 and 3% buy-to-let rates are long gone. I think depending on how long we're in this kind of recession, there's kind of a lot of talk of it being a long one. There might be more stimulation kind of going into 2025 to kind of drive activity, but it's hard to kind of forecast what's going to happen day by day. I mean, every time I check the news, so this might be out of date by tomorrow morning. So who knows? I
think that was a good point there.
Sorry, Chris. I was just going to say, obviously Nathan mentioned that, when Truss was in power, it was 6%. That's one article in the press that say that, and that's where you have to be really, really careful and look at the whole picture and go, actually, no, it was always predicted at 4.5 or whatever. But again, you just have to watch what is being written and watch what the narrative is, and make sure that you don't kind of get into that rabbit hole about reading it. I think Nathan's view is quite pessimistic, glass half empty, whereas I'm glass half full. I genuinely do think that things will improve. It may be pushing out to back end of next year, early following year, but I do believe we will see 2-3% buy-to-let interest rates again one day.
I think the swap rates, obviously, they're a good indicator of what the markets think will happen. And certainly September time, they were racing ahead, and some of the numbers were quite scary on that 2 and 5 year period. But I think since the recent changes have come back in, they've normalized a little bit more. They've come back to that kind of 4.5 forecast. So hopefully, yes, it looks like they'll go up, but hopefully it won't be as painful as it was talked about being.
I think it's that Truss premium is now out of it, which has obviously calmed it. But I think what's really interesting is Andrew Bailey on the last time that the MPC met come out and said that the markets are pricing in too high at 4.5, and the market reaction was to price higher than the 4.5. So it was as if the reassuring from him actually done the opposite. So it's just volatile, isn't it? It's so difficult to know. And I think even looking at the war in Ukraine, when was it, a few weeks ago, when that the shrapnel missile hit Poland, and straight away it could change everything, I guess, with just one flick of a switch. So I think it is difficult to kind of think, a week or 2 weeks ahead, I guess.
Yeah, definitely. And look, I think it was mentioned earlier, this was always going to happen. We've been through a sustained period of low interest rates. Even during COVID times, we had all the stimulus that was put into the market that needed to be repaid at some point. So this correction was always going to take place. I think the painful period at the moment is just it's happened quicker than people expected it to, rather than that gradual return to normality.
I don't think I'd have ate out to help out as much as I did had I known rates would have gone up this fast, to be fair as well. So
having said all that, and I appreciate there's been quite a bit of negativity on this podcast about the market, but do you think the future still looks bright for buy-to-let?
Yeah, definitely. I think we went through changes in 2016 where all the reports were the buy-to-let market is dead, buy-to-let market is it's not, and it did. It shifted, it diversified, but it remains strong, and I don't think anything now is going to cause that to come off course. I think the one thing that we as lenders, as brokers, as the mortgage market have shown over the past 10, 15 years is how resilient we are. You know, we've gone through credit crunches, we've gone through MMR, we've gone through, you know, all the FCA, PRA changes, and we still come out stronger, and we still come out lending, we still come out well funded, and we still come out in a position to help customers out there. So ultimately, no, I don't think this is the end of the buy-to-let market. I think the buy-to-let market will remain strong.
Definitely, yeah, no, definitely agree. I think, like we said all along, I think fundamentals are still there. People want to rent. I think the average age of a first-time buyer in the UK is around 33, and that is going up. As a country, we don't build enough properties either. So again, that pressure or that need for the private rental sector is always going to be there. So yeah, I think obviously not going to. I think there is definitely a massive market for it. As Emily said, I think it will become, again, even more professionalized as more landlords look at, you know, with your ones and twos, you know, if someone decides to move out of there or doesn't pay their mortgage, how do they kind of pay that? So I think we will get a bit more professionalized. I think we'll still continue to see that limited company trend as well. What we're seeing a lot at the minute as well is landlords just increasing the rent to cover the rental increase. But then you're obviously increasing the tax liability they're obviously paying on there as well. So again, I think a lot of people will be looking at complex structures and different lenders, I guess, to kind of fit that, to fit their need, I guess, for how they manage their portfolios moving forward.
Interesting. Yeah, I believe the future is very bright for buy-to-let. I think it's just a different path than I think the one that we've been on previously, rather than it being, Nathan, as you mentioned, just walk into a building society and get a buy-to-let mortgage. I think now the need for the broker has never been greater. I think you've got to stay closer to the client, closer to the landlord, understand their plans and treat it as a business. You know, really understand what they want to achieve, what they want to do, and then walk with them through that journey. And I think the future is still strong there. If you could make one change to the buy-to-let market, what would you want to do? Nathan?
I'd probably say better relationships, I guess, between government and landlords. I think we've covered off a lot, but I think there's been an onslaught of regulations, changes, you know, barriers for landlords to rent out properties. I think when you contrast that with a housing shortage, you know, the cost of living crisis, that volatility in the market, and the need for people to rent properties, I think it would be if that would kind of lend into potentially PRA reform or something to kind of look at how do we kind of look at, you know, if this is the new normal, we've potentially got mortgage prisoners, we've potentially got landlords who are kind of stuck with lenders and they can't, you know, exit or PT. So maybe a kind of softening for landlords to be able to sort of help out the market that the government was kind of failed on, I guess.
Okay, that's a good point. I think a lot of the times the private rented sector is looked at as being the enemy of the first time buyer because there's not enough stock there for other people to buy, when actually they fulfill very different needs. Yeah, that's a good point. Thank you. Emily, what would you like to see change?
I would say similar. I think specifically though, probably just the ICR calcs, or maybe more flexibility from the PRA in terms of being able to offer different ICRs depending on the client. So rather than a prescribed, you know, if you're doing a like-for-like remortgage, you can have this ICR or whatever. Actually do, again, more holistic based on the client, based on the individual circumstances, and then give lenders that flexibility. I think particularly in times like this where, you know, there are pressures on the ICR.
Yeah, it's a very good point. That's where the calculations were brought in. Were brought in when rates were beginning with 2s and 3s, whereas now rates are as far as 7 and 8 at some point, and we're still applying the same calculations to it.
Do you think, Chris, what would be the one thing you'd want to change?
This is very unusual one. This one, throwing it back to me. I think the ICR for me. I think that's something that we've talked about internally quite a while. Having that flexibility from a lender's viewpoint, where you can make the decision to do that responsible lending rather than have it dictated for you. No lender wants to lend risky money. I think lenders have learned lessons from the previous credit crunch. And again, the picture, the position we're in now is very different to where we were 10 years ago, 15 years ago. So I think the market's stronger. I think, yeah, a change to that, a PRA change would be useful for them, I think. We're running out of time on this one. It's gone quite nicely this morning. Can you give us an example of a recent case that you feel really shows your criteria and flexibility? Emily, do you want to start us off with this one? You can pick any of your 3 brands. That's fine.
So I will do Ainsbay because that's the one that I'm sort of most involved with at the moment. And I think the biggest and best thing about Ainsbay is when there's multiple properties, it's one application for a starting point. And when we are looking at higher loan sizes, so larger portfolios, then we are doing priority underwriting. We are looking at, it's not in each individual properties, it's the portfolio as a whole. And again, when it's a complex structure as well, so it doesn't just have to be a limited company, it could be a trust, it could be a SIP, some various different tax efficient ways to have your portfolio. And I think that's where Ainsbay really comes into its own on buy-to-let.
Yeah, we've had 2 large portfolios go through recently with you, one 23 properties and one 16, and that ease of underwrite was one of the key decisions of getting that with you.
I think the other thing as well, I know you said one thing, but I'll say 2 things, is large student blocks as well. So again, big student accommodation, which have shown throughout the pandemic to be really well occupied. So quite low risk lending on those. So we're still really keen to do those. And we actually have now got in-house valuers, so who are quite happily go out to those properties or those portfolios and actually do a bit of evaluation before the customer spends any money. We still need a full val, but it kind of lets us kind of go out and look at the properties before we actually charge the client anything, which I think is a really good option.
Yeah, nice. Nathan?
Oh, I think
yeah.
Should I carry on with USPs about OSB?
Maybe the builders have taken his collection off. Yeah, we'll come back to him if he comes back on there.
He'll be back.
He's going to jump back in a second. So anything from one of the other one as he's reconnecting?
I think, again, just across group, it's flexibility. So it's being able to use precise if you want something quick, that's black and white, that competitive on a rate side. If you need that next level of flexibility, manual underwriting, you look at Chem Reliance. And then if you want to go next level specialist, then you've got Intermediary. I don't think there's any other lender out there that can say they offer those 3 levels of product within the one group, which I think is fantastic.
Thank you. I think we've got you back now, Nathan.
Yeah, sorry about that.
That's all right.
I thought you thought I was ditching on the hardest question, but
we blame the builders. It's fine.
Yeah. So I guess like for us, specialist property and the kind of structures that we can allow that to go in. So we had a case about 2 weeks ago. Customer bought an old sort of Victorian property, split it into 2 separate units. Didn't want to split the utilities, so it was a shared water, shared electric meter. And one of the units was 26 square meters. So that is fine with us. What we can also do then is in the sort of complex structure that we can allow that within the limited company is that we had the 2 directors on there and we allowed an intercompany loan from the trading company over to fund sort of onward purchases as well. And we're also fine as well with layering shareholding. So if you say, let's say we had an intercompany loan fund the deposit of a transaction, we could then put that company on as a shareholder. So it sits within a group structure. So we're getting quite a lot of those at the moment, but kind of bread and butter stuff for us, mum and dad maybe as director shareholders with the children on as shareholders as well. And anyone sub at 19% share. It could be foreign nationals, as I said, other companies. We're not doing any sort of ID checks, any company checks on there either.
Okay, thank you. I think the overarching thing for me this morning then is that It's still a positive market for buy-to-let. There's still opportunities out there for landlords and for brokers to stay close to clients. And we should be seeing some more innovation very shortly from a number of lenders and looking for ways to solve these problems for borrowers. Yeah. Any final comments? No. Excellent.
Thanks for having us. Thank you for hosting. It's been really, it's an enjoyable hour, actually. I think it's gone quick, which is a good sign, isn't it?
Yeah, time flies when you're having fun. That brings us to an end of a great session today. So from me and on behalf of all of our attendees, Nathan, Emily, thank you for lending us your expertise today. And I hope everyone found it as useful as I did. If you do have any questions, if you do have any cases or concepts that you want to talk through, please give us a call. Our number's on the bottom there, 01827 301070. Our mortgage desk are more than happy to take your calls and see how we can assist, or visit our website. We are ready and here to help. Join us on the 15th of December for the final Crystal webinar of the year with the Complex Cases Christmas special hosted by Dan Morris. And finally, from me, let me take this opportunity to wish you all a very Merry Christmas, prosperous 2023, and I look forward to seeing you all again soon. Thank you. Bye.
Bye, everyone.